Separately managed accounts have been gaining traction amongst advisors and investors for the flexibility and transparency they provide. Joining me today to discuss this product class and where it is heading in 2016 is Andrew Tracy, Executive Director of Investment Services at JB Were. Welcome, Andrew.
Morning, thanks for having me.
So Andrew, can you explain what an SMA is and how they differ from other investment products?
Sure, an SMA is it's a very efficient way for clients to own direct shares or listed securities and still get access to professionally managed investments. So some clients will have a direct equity portfolio. This gives them the professional management that sits over the top of that. It differs from other investment products in that it is issued by a PDS, similar to those, but it sits really between managed funds and direct shares. So it has some of the good features of managed funds in professional management and the structure and the discipline, but it also has sort of lower costs, more tax efficiencies and transparency versus a managed fund. Direct shares, very similar.
So what benefits do they provide?
The SMA offers benefits to both the financial planner and also the end investor, and there's some benefits in there for the dealer groups as well. If you're looking at the end investor, they get transparency on their investments. They can see exactly what they hold inside that portfolio. They actually get access to professional funds management, so it gives them a real discipline and investment structure around what they're doing. There's no cocktail stocks that might end up in your client portfolios that we see from time to time in private client portfolios. It gives them transportability. They can move their shares in and out of the SMA, so there's no CGT event on some of those stocks that are held at the same weighting inside the SMA. And for the financial planners, I think that's really the big driver of why SMAs have been so popular now in the last 12 to 18 months as it has been over the last 7 years, because the financial planners actually now have a real tool to make their financial planning practices much more efficient. So it removes a lot of the compliance, the regulation, the execution, back office costs, and gives them a higher valuation for their business.
And how have they been received by the advisor community?
SMAs are probably as hot now as I've seen them for the last 7 years. Probably the last 12 to 18 months has really been the key. What's different now versus 7 years ago, I think there's three key reasons why they've been accepted so well now by advisors. One is that there is the cost to client conversation, what the client is actually paying, is much lower now than it was 2 or 3 years ago. I think costs have come down for platforms from about 80 basis points down to about 40 basis points. So that admin cost is halved, and that flows through right onto the client. The other part is the availability. Platforms now have, I think the numbers are in the Investment Trends survey, 25% of planners now have access to an SMA on their primary platform. Now that comes up way up from 7 or 8% over the last 2 or 3 years. So lower cost to client, availability, and the range of products now. If you look at the rating agencies out in the marketplace, Lonsec now, 3 years ago would have rated 2, maybe 3 SMA managers. Now they're rating 10 managers and 28 different products. So that's the reason why it's so much heat in the market at the moment. And we're even seeing some of the big fund managers now starting to look at some of the listed SMA providers, as well as a bit of corporate activity happening in that space. So it's definitely becoming more mainstream. As to how they've been received by planners, we did an investment trend survey earlier this year, February 2015, and JB Were and Investment Trends got together and we surveyed 670 odd financial planners, and it came out, the numbers were 20% of financial planners surveyed are now actually using SMAs as part of their mainstream offering, which is a very strong number. It's up from sort of 15 to 16% the previous couple of years. So 20% are now using SMAs. 23% of financial planners in that group that were surveyed have said it's their intention to start using SMAs in the next 12 to 18 months. So we can see that number, potentially on those sort of figures, doubling over the course of the next 12 to 18 months. So it's definitely becoming more mainstream. And I think the acceptability of SMAs, clients are asking questions now about SMAs. There's a bit more out in the press, more interviews like this. Advisor education, client education is a real big piece of what those financial planners are demanding from the market.
Okay, so what type of clients are best suited to SMAs?
I think it's pretty much all clients. Most investors in Aussie equities would either historically have a managed fund exposure, so they'd be sitting inside a unit trust. Others would be self-managed super funds, as an example, they like low cost and control, so they'd look at having direct equity portfolios. So an SMA kind of sits right between the two of those, and pretty much any investor who's been a managed fund or a direct equity portfolio can use the benefits of an SMA. The direct equity guys will have a professionally managed direct share portfolio. That's how they would describe an SMA. And the managed fund investors would look at it and say, well, that's a more transparent, lower cost, more tax efficient vehicle for me to invest in versus a managed fund. And I think that investment trends survey, when we did that, 51% of the planners actually said that they could see SMAs as being a more efficient way for them to manage their self-managed super fund clients in Aussie equities.
Okay, what kind of new product trends can we expect in this space?
There's plenty out there. There's quite a lot of competitors have come in over the last 12 to 18 months. Originally, as I said, when Lonsec 3 or 4 years ago was only rating 2 or 3 managers. From the large investors, fund managers, down to the small and medium-sized ones, there's quite a few coming in. The new range coming in, I think there's been and the trends in investment trends really pointed to that, is in terms of multi-asset class. We want multi-asset class coverage. So we're starting to see those that don't want to do their own asset allocation outsourcing that as well as the stock selection to the SMA manager. You're starting to see demand for international SMAs, and we're working on one with our colleagues at NAB to bring out a solution in the SMA space for the international side, because that's very, traditionally for a direct client, trying to go international is very clunky, very expensive, and for a managed fund, you know, the MERs and the transparencies are an issue.
And what's most likely to drive growth in the SMA sector in 2016?
I think there's a couple of things out there. One, I think, is that educating the senior management within dealer groups, because some groups are really well advanced in getting on top of this and using this as a solution to scale up and make their dealer groups more financially valuable. More funds under management, more efficiency equals a greater value. There's also the compliance side of things, that it removes a lot of the compliance risk from the bottom end of financial planners' client book. So that's a good thing for financial planners. Educating the dealer groups, educating the planners is one thing we've been doing quite a lot of. The NAB group, Antares, Redpoint and JB Weir have been really out there doing a lot of this sort of work to try and get the message out there. And I think the final one is, the key might come down to educating the end investor. And the end investor's never really been educated to my experience, in the whole investment management process. There's been people educating planners and advertising and marketing, but no one's actually taken the next step down to start educating the client. And I think now technology is allowing us to be able to do that, and that'll be start the investor demand-driven side of things. So they're the sort of main ones in terms of drivers for 2016.
And what's next for JB Weir in 2016 with SMAs?
2016 for SMAs for JB Weir, we're looking at first quarter next year, hopefully bringing out a solution on the international side. We're just putting the final touches to that now, so that we'll have a solution there on the direct international side of things. There's a lot of demand from that for, well, the investment trends survey really pointed towards that. We talked to our internal advisors, and they're screaming for a scalable, cost-efficient, dynamic international exposure. And the JB Weir ones are very high conviction and concentrated portfolio, so they're quite condensed, and that's the solution that they're looking for in that sort of space. So we'll come out with an international. We've brought out the multi-strategy one recently and a listed fixed income one, and we'll look at bringing out some more advisor and dealer group education over the course of 2016, because there's probably 2 or 3 dealer groups have come to us already wanting to do an advisor education piece for next year. We've already been doing CPD training for the aligned advisors within the NAB group, about 7 or 8 dealer groups there that we're working with. And as I said before, I think the end investor education is a real theme that will start to pop up, not just from the NAB group, but also from other investment managers around town, now that technology is allowing us to do that.
Fantastic. Thanks so much for joining me, Andrew.
Okay, thank you.